So in some ways you feel like, yeah, people are bringing their book down a little bit, getting ready. But then you kind of look up and you're like, but you have 18 vol, you have the S&P in a 1.5% drawdown, which is essentially nothing. So yes, a little bit, it's like people took off, tiny, tiny edges of their portfolio. No meat whatsoever.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves a risk
All right,
and possible
everybody,
loss of
welcome
principal
back to
capital.
another
Please seek
edition
advice from a
of
licensed
Daily
professional.
Dots. Here on Thursday, August 21st, Chase flying solo with you today. And before I get rolling, I'm going to have a shameless, selfish plug for my own podcast, Tailor Made Macro. I just released a episode for the first time in almost a year. A book episode about a really, really good book called Soul in the Game by Vitaly Katznelson. You can go find it anywhere, Tailor Made Macro. I'm going to go through the markets and then a few things to discuss today. Somewhat interesting day, but pretty low vol at the same time. S&P down 0.4, Q's down 0.46. Another up day for IWM at up 0.25. All world ex-US was down 0.4, Mag 7 down 0.5, equal weight down 0.35. Dollar was up 0.42. So somewhat notable to me that all world ex-US tied the US despite the fact that the dollar was up 0.42. This is one day, but still interesting little correlation there. And speaking of correlations, the Chinese equity market and the European equity market have become very correlated of late, which, I don't know, just interesting. Oil was up about 1.2% on the day, Bitcoin down about 1.7. You had gold pretty flat, and despite that, gold miners up about 1.7. Again, dollar up, having gold miners up 1.7 just sticks out to me, especially with gold flat and oil up for that matter. Silver up about 0.8. As far as yields went, you had the 2-year up about 4 basis points, the 10 also up about 4, and the 30-year up about 3. So, nothing major, but at the same time, 30-year yields now about 4.92. And it's interesting. In some ways, it feels like we're pretty close from, the highs of the last 5 years. But at the same time, you're 8 basis points from being above 5. And we've only spent 3 different weeks, in the last couple of decades above 5%. So you're one day from being above 5%. And we've only done that for 3 weeks in the last decades, right? So interesting. And if Jackson Hole goes a certain way, I could imagine, the 30-year having to do that. But, or more importantly, honestly, the data after Jackson Hole, the next jobs print and inflation print. But vol closed the day out up about 1.7%. You're at, 18.6. I was having an interesting conversation with a research client earlier today. And in some ways, you can feel people kind of de-risking heading into Jackson Hole a little bit. Like, that is a palpable feeling. I think we've been down 4 or 5 days in a row. So in some ways you feel like, yeah, people are bringing their book down a little bit, getting ready. But then you kind of look up and you're like, but you have 18 vol, you have the S&P in a 1.5% drawdown, which is essentially nothing. So yes, a little bit, it's like people took off, tiny, tiny edges of their portfolio. No meat whatsoever. And to talk more about that, Qs are down 2.9, drawdown, Mag 7 3.4. Russell 2000 still over almost 7% drawdown, but that's more of a function of the last few months, not necessarily right now. It's actually been outperforming this week. But so maybe people got ready around the edges, but I think if Powell comes out in any way hawkish, or even half hawkish tomorrow morning, you're still going to have to see some potential fireworks. My math suggests we did close the day in negative gamma, but like barely close enough to just call it neutral still. But more to the point, if Powell comes out hawkish and the market goes down on that tomorrow, it will feed on itself. It will be enough to trigger that reinforcing loop, which brings a risk of a bit of a shot of volatility for sure. But that requires him doing that. If he comes out, doesn't say much, or he comes out and says, "Yeah, we're going to cut probably once or twice," like we're worried about that jobs report, then the opposite. You'll probably see vol compress. You'll see equities run. I especially think you would see small caps run. Small caps have a weird dynamic where they have a lot of floating rate debt. So yeah, rate cuts would be wonderful for them. Now, if you have rate cuts because the economy's slowing, less so. But if you sort of have a thing where the Fed's going to cut despite the fact that the economy's okay, then they get the best of both worlds. It's really the only environment where small caps could outperform. So I think that becomes the thing if he is, dovish. And then if he's not, it's sort of a, buy dollars, sell kind of everything else, buy vol, all that kind of stuff. But we'll see. Nobody knows what he's going to say tomorrow. So hard to say.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
There's a little bit of data out today. We got S&P does their own PMIs. I don't really track them that closely. I prefer ISM because of the track record and the duration and the history of it. But they came out strong for U.S., both manufacturing and services. The composite was a good bit better than expected. Part of the reason we had dollar up, rates up today for sure. And then we had existing home sales, which were better than expected and, half decent. At the same time, we got some data out that shows that canceled home contracts were essentially the highest since, I think it's Redfin maybe, that started collecting this data back in 2017. So only 8 years of data, so you can't go too crazy with this, but 15.3% of the contracts in July got canceled. And obviously this is because rates just kind of refuse to let go and go down enough to bring people in. Obviously if rates keep going higher on the back end, that's going to keep housing down. It's going to be a problem for housing, continuing. At the same time, like obviously if rates come down, I do think there's a really big wall of buyers if you can get mortgage rates down to like 5.5, but that I struggle to see us doing that soon. I see a lot of kind of yellow flags, maybe red flags 6 months out, a year out. Next month or two, though, the economy seems like it's doing well enough. I wanted to talk about. I kind of went down a rabbit hole today on something I've talked about a little bit in the past, but I wanted to go deeper on, and I looked at this a new way. I had never looked at it before, and I was thinking about the impact of capital inflows into the U.S. and basically what that's done, not just to our markets, but to our economy. And what has made this front and center for me is reading Russell Napier's book about the Asian financial crisis in the 90s. He just makes it really clear that, really the genesis of that was there's a bunch of capital flows from the rest of the world into Asia. And if you get a bunch of capital inflows, especially if you kind of sterilize them through currency markets, like you end up pushing up the value of your assets, which ends up feeding into higher growth. It becomes its own like self-reinforcing thing. It becomes its own narrative. Next thing you know, everyone's like, these are just amazing countries. Like their economy's amazing, not just their stock prices. Like everything's awesome. And it's easy to kind of fall into that trap because you look around and everything's getting better. Everything does look awesome. Never mind the fact that sort of just because, people put some money in there, it became its own reflexive, fundamental. As I've mentioned before, flows are the real fundamental, but it's hard, I don't think most of us think of it that way in the US, but the reality is the same way that they were the kings of capital inflows, kind of in the 80s, 90s, whatever, like, well, that's been the US for the last 20, 25 years. Like we're the kings of capital inflows. The rest of the world has put a shocking amount of money here. If you look at like net international investment position, it's wild how deeply negative that's gone, which suggests, if you net out capital flows, we've got an insane amount of capital inflow. Obviously, the problem with that is if it becomes capital outflows, it unwinds a lot of that. Whether that's first, obviously, it starts with asset prices. If asset prices contract because of the capital outflows, that becomes its own problem. But then downstream of that, people don't feel rich. They consume less. That consumption less, it ends up being less growth, which means less employment, which means even worse, equity returns, which means even you get the point, feedback loop. And that's not like just like a 6 month, quick recession feedback loop. That's like a nasty, more secular feedback loop that's possible because the inflows have been secular. They have been, huge for year after year for over a decade. But I ran the numbers to see as a way to zoom out and look at this in a really big picture. And since 1980, household net worth in the U.S. is up by over 1,700%, but nominal GDP is up 973. So if you think of it from a net worth to GDP perspective, that spread is blown out higher, showing to me that we have a lot of essentially paper gains we're all banking on being real to support the real economy. But it's not super sustainable probably to have massive net worth gains without massive growth gains. Not to mention you can look at like personal income, same thing. Like personal income has not grown nearly the way that household net worth has. And obviously that's both equities and real estate. And then I thought about this from the other perspective, and that is kind of like how much of the equity market makes up like all of our baskets, right? So when I was born in 1983, yes, I'm old, stocks were 43.6% of GDP. So less than half of GDP. Now they're 221% of GDP. And the reason that's important to me is because if you have a drawdown, in a sense, it's 5 times more impactful than it was back then. So when I was born, if the stock market went down 30%, that's a bummer. But like, it's such a small piece of the economy. Is it really going to hit the economy? Are people going to legitimately change their consumption patterns? Now, with it being 221% of GDP, if that gets, cut in half, then that's like 110% of GDP just vanished, right? Big deal. But not only that, but, stock ownership as a percent of households' wealth went from under 10% back then to like 42% today. So you 4x'd how much of the household asset bucket is in the equity market versus back then. So it was a tiny, tiny sliver of the economy. Well, a small portion of the economy back then, and a small portion of all of our savings. Now it's a massive proportion of our savings, and more than 200% of the economy. It just highlights the fact that drawdowns mean more to us as individuals, mean more to us as an economic system, which means at the moment we can kind of least afford to have capital outflows and a drawdown. It starts to become, in some ways, more and more possible, especially given some of the policy things. And I don't just mean like tariffs like leading to that. I mean like active discussions with people in government talking about like taxing capital inflows, things like this, to try and get the trade deficit down, which in some ways, very, very isolated ways, in my opinion, makes sense. But given this dependence that we have built on capital inflows and asset prices, anything to punish capital inflows, anything to chase away capital, becomes a potential, just sort of significant problem. It could be the last snowflake that creates an avalanche. I'm not trying to be like super negative here. Really more of a scenario analysis way of looking at potential issues due to capital flows, which are, a boring term, boring like thing that the average person and investor are not going to think about. We just look at stocks going up every day and just assume it's because, Microsoft's just really good at their job, or we assume, even that it's passive or inflows or whatever. Problem with passive inflows is if you have a drawdown because of capital outflows, then that would lead to some job losses, which leads to passive outflows. And again, it's just like another gear in this system that would flow back the other way. Which again, as I've often mentioned, this is where, like, to me, systems thinking is vital when looking at economies and markets, because it is a big system. It's more than the sum of its parts. Small gears going back the other direction could change everything. It's sort of the butterfly flapping its wings thing, right? I just want to highlight that, put it on everyone's radar, not to like say like we're in big trouble soon. This could go on for the 5-10 years, who knows, longer. In some ways, dismantling that system is required and necessary. So the pain to get to the other side, you can argue, kind of needed. We've essentially, we're riding a tiger we can't get off of. But to like heal that foolishly built system, like you eventually have to get off the tiger and see what happens. But something worth kind of keeping in the back of our head, especially if we ever at any point start looking like the capital outflows are picking up or accelerating or becoming real, or if other countries start to incentivize capital coming home, or if the US more so incentivize capital leaving. Just remember that it's not just as simple as like, oh man, we're going to lose $1 trillion of European money, or $1 trillion of Asian money. It's much, much more than that, because of the impacts that it can have in the broader system. But a pretty quick one today for me. I will reiterate tomorrow morning, 7 a.m. West Coast, 10 a.m. Eastern. We'll have Jackson Hole speech from Powell. None of us know what he's going to say. It might be hardcore Duff, hardcore Hawk. Hardcore tries really hard not to say anything. None of us know. Clearly, the independence of the Fed is under attack, and we saw more of that this week in a very significant way. So, I think that there's a possibility that he goes out of his way to address that instead of ignore it, which would be, of course, interesting, not just for markets, but kind of for the political and just kind of civil service landscape, really, tomorrow. So all that being said, and that's it for me today. Don't forget, you can download, subscribe at knowyourriskpodcast.com. Check us out on YouTube and everywhere else, social media. That's it for me today. Cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.